As we watch the market open on this Monday, November 10th, 2025, shares of Opendoor Technologies, ticker OPEN, are currently trading at $6.83. That's a sharp move up this morning, a gain of over 4% or 27 cents per share on fairly active volume. Now, for many investors, seeing this pop is exactly what they were hoping for, a sign that the bottom is in and the so-called open army is ready to fight back. The expectation, fueled by relentless social media chatter and a stock price that has delivered meteoric, multi-100% gains this year, is that Opendoor is a coiled spring, a high-growth tech disruptor on the verge of its next massive leg up. The reality, however, is that this morning's green candle is painted against a backdrop of absolute carnage from last week. This is not a breakout. It is an attempt at a recovery after the market delivered a brutal verdict on the company's new strategy and its performance in a frozen housing market. Just last Thursday, following its third-quarter earnings report, the stock was decimated, plunging nearly 15% in a single session after management revealed a wider-than-expected loss, even as it managed to beat revenue estimates. That earnings report is the dose of cold water that must be reconciled with the bullish narrative. The company posted a loss of 12 cents per share, significantly worse than the 7 or 8 cent loss analysts were anticipating. This happened despite revenue coming in at $915 million, which cleared the bar. What this tells us is that the company's core business model, iBuying, where the process of buying homes directly from sellers for cash, making light repairs, and reselling them for a profit, is struggling severely with its margins. The entire bull case for Opendoor rests on its ability to do this profitably at scale, using data and algorithms to buy and sell thousands of homes. But when the housing market itself is locked in what many are calling a deep freeze, that model is put to the extreme test. High mortgage rates, which are still hovering well above 6% despite 2 recent small cuts from the Federal Reserve, have created a nation of locked-in homeowners. These are people sitting on 2, 3, or 4% mortgage rates from the pandemic era who simply cannot afford to sell their home and buy a new one at today's rates. This is strangled inventory and transaction volume, which is the very oxygen Opendoor needs to breathe. So while the retail investing crowd sees a disruptive technology company, the market's reaction last week shows it sees a company that is fundamentally chained to the cyclical, interest rate sensitive, and low-margin business of flipping houses. The narrative was further complicated on Friday when the company announced a registered sale of 180.6 million shares of its common stock, priced at $6.56. This influx of shares can be interpreted in 2 ways. Either it's a necessary move to shore up the balance sheet and provide liquidity for its new AI-focused pivot, or it's a sign of dilution that puts a cap on any near-term upside. Given the timing, right after a post-earnings collapse, it did not inspire confidence and kept the stock pinned near its lows to close the week. This morning's rally is a direct reaction against that pessimism, a classic battle between those buying the dip and those who believe the company is in serious trouble. The expectation is that the new chief executive, Kaz Najatian, can deliver on his promise. He is attempting to reframe Opendoor entirely, calling it an AI-led company, and setting a new target to achieve break-even on an adjusted basis by the end of 2026. This is the new carrot for long-term investors. The reality is that 2026 is a long way off, and the company has to survive the brutal housing market of 2025 first. This brings us to the immense pressure from short sellers. This is a critical piece of the puzzle that many retail investors are watching closely. The expectation is that Opendoor is the next great short squeeze, a stock held down by predatory funds that will be forced to cover, sending the price into the stratosphere. The data here is fascinating and tells a conflicting story. The reality is that the short interest is in fact extremely high. As of the most recent data, a staggering 22.7% of Opendoor's entire public float is sold short. That is an enormous, deeply pessimistic bet being placed against the company by institutional players, involving over 161 million shares. This is not a small niche group of bears. This is a significant portion of the market betting that the price will fall further. This is where the short squeeze narrative gets its fuel. But then we have to look deeper, at the cost of that bet. Typically, a stock with such high short interest that is also hard to find and borrow will have an astronomically high borrow fee rate. We saw this with other meme stocks where borrow rates climbed to 50, 100, or even 200%. For Opendoor, the current borrow fee rate is just 0.66%. That is incredibly cheap. It means that shares are plentiful and easy to borrow for anyone who wants to place a short bet. This detail completely challenges the expectation of an imminent forced squeeze. The short sellers are not in pain. They are not scrambling for shares, and they are not paying a high price to maintain their negative positions. Furthermore, we can look at the days to cover ratio. This metric tells us how long it would take for all short sellers to buy back their shares based on the stock's average trading volume. A high number like 10 days would indicate a crowded short trade, where everyone trying to exit at once would cause a massive price spike. For Opendoor, the days to cover ratio is only about 1.6. This is a very low number, and it's a direct result of the stock's massive trading volume, which topped 200 million shares on Friday alone. With that much liquidity, the shorts can get in and out with relative ease. They are not trapped. This is the actionable insight every investor needs to understand. While the 22.7% short interest looks explosive, the low borrow cost and low days to cover ratio suggest the short trade is comfortable, not panicked. Investors looking for a squeeze should monitor the borrow fee rate daily. If that number starts to spike into the double digits, it signals that the available shares to borrow are drying up. That is the true catalyst for a technical squeeze, not just the high short interest percentage alone. What's your take on this? Do you believe the low borrow fee means the shorts are right, or is it the calm before the storm? To understand the full picture, we have to briefly pull back from the daily stock chart and look at what Opendoor actually does. Its business model, known as iBuying, was meant to replace the traditional, slow, and agent-driven process of selling a home. The idea is simple. A homeowner goes to Opendoor's website, types in their address, and receives an all-cash offer for their house within 24 hours. If they accept, Opendoor buys the home, handles the repairs, and then lists the home on the open market, aiming to sell it for a higher price. The company makes its revenue from a service fee, typically between 5 and 14%, which it charges the original seller for the convenience and certainty of a quick cash sale. This model worked beautifully when the housing market was a one-way rocket ship from 2020 to 2022. The company could buy a home, and by the time it was listed a few weeks later, the market had already risen, all but guaranteeing a profit. But when the Federal Reserve began its aggressive rate hiking cycle, that entire dynamic inverted. Suddenly, Opendoor was left holding a massive inventory of homes that were losing value by the day. This led to catastrophic losses and forced it, along with its competitors, to pull back dramatically. This is the past performance that informs the current skepticism. The company is now in a show-me state. It has to prove that its new AI-driven algorithms are superior, that they can accurately price homes in a stagnant or declining market, and that it can manage inventory and repair costs with surgical precision. This is why the new CEO's 2026 break-even target is so important. It's an admission that the old model was flawed, and that the new, leaner, more AI-focused version of the company will take at least 2 full years to become profitable. This is the reality that is clashing with the meme stock expectation of a quick flip profit. The professional analyst community, for its part, is deeply skeptical. The consensus one-year price target from analysts who cover the stock is a bleak one, $1.78. Some firms have targets as low as 71 cents. This stands in sharp contrast to the retail Open Army, who believe the stock is heading back to its 52-week high of over $10. This gap between professional and retail sentiment is one of the widest on the market today. Looking forward, the entire thesis for Opendoor, both bullish and bearish, hinges on the macroeconomic environment. The bulls are betting on a pivot from the Federal Reserve. We have already seen 2 quarter-point cuts in September and October. If inflation continues to cool and the Fed cuts rates more aggressively in 2026, mortgage rates will fall. If mortgage rates drop back into the 5% range, it could unlock the housing market, bringing sellers off the sidelines and creating the transaction volume Opendoor desperately needs. There is some optimism on this front. Warren Buffett's Berkshire Hathaway Home Services recently noted that this fall could be a turning point for homebuyers as inventory is slowly rising and price cuts are accelerating.
In this scenario, Opendoor could thrive, using its significant cash position to buy assets at a market bottom. The bear case is that the housing market remains frozen for years, locked in a state of low volume and high prices as rates stay higher for longer. In this world, Opendoor's cash dwindles as it fails to achieve the scale needed to cover its operational costs, and the 2026 break-even goal becomes a fantasy. The company's recent earnings miss on profit, even while beating on revenue, suggests the bear case currently has the upper hand. In summary, the stock's 4% rally today is just noise in a much larger, more violent debate. The expectation is that Opendoor is a high-octane tech stock, a mean favorite with a massive short interest that is primed to explode higher. The reality is that it's a capital-intensive real estate company in a deeply frozen market, one that just missed profit expectations, diluted shareholders, and is now being run by a